Have a listen to this. Have a listen to this.
Now, that kind of talk this week dragged Australia's share market to a two-year low. There are, of course, complex reasons for that.
He was the big spender. The big spender.
Doing the grocery shopping could take a huge chunk out of the family budget.
And that's finance.
Hello and welcome to Comedian versus Economist. We demystify the world of money and help you get a handle on the bigger picture. My name's Adam and we're joined as always by my little older brother and real-life economist, Thomas. Hi, Thomas.
Yeah, g'day Adam. How you going?
I'm doing well, thank you. We're recording on Friday night, which is a bit of a different experience. So this is a few days before we release next Wednesday, but that's because we're going to be catching up in real life, IRL, next week, Thomas, for a bit of a holiday. So I'm looking forward to seeing you tomorrow, in fact. So that'll be fun, but lots to get through today. Don't forget the share market trading game, the ASX Sharemarket Trading Game, starts tomorrow. So there's still time to register. In fact, you can register right up until the 28th of April. But why would you want to wait and miss out on all those gains that you're going to get early on in the game? So don't delay, go and register right now and join in the fun with us, part of the ASX Sharemarket Trading Game. But Thomas, on with the show. Lots to get through, and starting with war. Whoa, what is it good for? Also, wages data is out, so we're going to find out how much extra you'll be getting in your pay packet now. That's how it works, isn't it, Thomas? That's right. We'll take a look at AGL, who find themselves in the proverbial crap sandwich. It doesn't know what to do, but it also doesn't want anyone else to tell it what to do. And I didn't really care about inflation, but now I hear it's going to push the price of beer up. I have a renewed zest to find out more. So I'll ask you a bit more about that later on. But Thomas, first of all, turns out there's more to the Lark Distillery story that we talked about last week than meets the eye. And Thomas, I think it's fair to say you're the closest thing that we have to a lawyer. So I'm just going to give you a bit of an update and you just let me know if we need to issue any sort of retraction or any sort of apology or anything like that. But there is some more information that's come to hand since we recorded last week. So if you did miss the episode last week, we talked about the managing director, former managing director of Lark Distilling, Jeff Bainbridge, who was seemingly caught in a drug scandal in Southeast Asia in 2015. Well, it turns out that he made it up. That's the best way I can put it. He misled some reporters from The Age, and which published the story. I got to be honest. Our flimsy research failed to turn up any contradictions to the story through minutes and minutes of googling to clarify the story. We couldn't get to the bottom of it. So it turns out he's misled The Age and everyone else. So he said it was a shakedown in a foreign city and they'd used it to try and extort money out of him. He was at a party in Southeast Asia somewhere, woke up in the morning and they showed him some video footage and he was in trouble. But it turns out, this has come to light in the last few days, that the video was actually shot sometime after 2020 in his own bedroom in an exclusive Melbourne suburb. So I don't know if that makes it better or worse. It's a much less interesting story it sounded so much more exotic when he was in Southeast Asia, 6 years ago.
Shakedown, the London Threat Assessment Agency.
I know. So
blackmailers.
I don't know what to believe anymore. I don't know whether there's going to be more that'll come out. The story was written was published in the Australian. I don't know if the Australian is just trying to really just take it as an opportunity to lay the boot into The Age. There's maybe some kind of some war going on there. It's not clear at all why he concocted this story in the first place, because it doesn't seem like it makes it a better story.
Oh no, I think it's a much better story. Yeah, you think about he's lost his job, right? So he's now in the job market. Luckily, wages are up, labour market's tight, good times. But he's in the job market again. He's going to a prospective employer. It's like the question is, why did you leave your last job? Well, I was a victim of a shakedown in Asia back in 2015 sounds a lot better than I got busted in my bedroom smoking ice.
True.
That's what I think his play is. But it's also kind of amazing he's managed to, because he sent screenshots of a supposed conversation with the blackmailers to The Age, I think. So they kind of went, oh yeah, right, this looks legit. But apparently they were just made up as well.
So I mean, maybe these are the things you do when you're high. You just sit around making up, amazing stories about your past. You just picture him sitting there just banging out an editorial or something for The Age, going, this would be great. You watch where they print this.
I was in Asia and there were ninjas coming in the window.
Anyway, so that's just a bit of an update. I thought we'd better clarify that because, a few people have had mentioned that to me over the course of the last week. So thought we'd better clear it up. But I, of course, stand by any jokes I made on the matter last week, whatever they might have been. All right, Thomas, the ASX Sharemarket Game kicks off tomorrow, as we've mentioned. There's still time to register. In fact, you can register right up until the 28th of April. So make sure you get on board, sign up, join in the fun. But, of course, the big news this week, and I think this is really important as we head into the ASX Sharemarket Game, is that Russia has invaded the Ukraine. It's all kicked off over there. And I think we should just take a look at what that means, I guess, globally across economies all over the world. And I'm really keen also to understand what kind of impact a global conflict like that might have in our local share market. So as we're getting ready to play the game and we're thinking about stocks that might do well and stocks that might not do well, this kind of changes the whole landscape. So, a conflict, albeit a long way away, has far-reaching ramifications for the globe, but also for our share market here. And we saw a fairly significant impact in the ASX share market this week. So just keen to get your macro lens, Thomas, on what I guess that particular war means, but also what trends we might see from wars in general that come out of a conflict like that.
Yeah, that's good. Thanks for that intro. I want to steer well clear of geopolitics because I'm way out of my depth there. But I'll have a crack at the macro outlook.
Yeah, sure. I thought you were going to have a crack at geopolitics. We're casting aspersions on former managing directors. Why not some presidents and prime ministers while we're at it?
Yeah, and it's an interesting one economically. Yeah, obviously war's pretty tragic. It's pretty brutal, but interesting one. Like markets reacted pretty badly to it. ASX is down 3% over the week. Definitely got the wobbles. To me, I think it's interesting because Russia's a heavy hitter in the geopolitical sense. It's got a population of 146 million. It's got a lot of natural resources and gas. It's historically been a very powerful nation. But while it's a heavy hitter geopolitically, it's kind of a welterweight in an economic sense. So, like Italy has half the population and fewer natural resources and has an economy twice the size of Russia.
Yeah, wow.
Yeah, and Poland exports more goods to the European Union than Russia does. And so, and like unlike China, is probably the interesting counterpoint right now, but like the Russian manufacturing sector isn't all that much to speak of. There's, you turn over anything in your house and it's not going to say made in Russia. It's probably going to say made in China.
We have a set of Russian babushka dolls which are made in Russia.
Oh, they were.
Yeah, fun fact. Yeah, Anna bought them when she was holidaying in wherever, Russia, St. Petersburg.
Right. So the point is, like, economically, it's not that significant. Where it is significant is with oil and gas and natural resources. I love a quote I read during the week. Jason Furman, who's a Harvard economist and a former advisor to Barack Obama, he said it's basically just a big gas station.
Right.
Russia is incredibly unimportant in the global economy except for oil and gas.
Right.
And so that's sort of where it gets interesting. Oil prices are up, but not all that much. It's sort of more of an issue for Europe. But Europe doesn't have a lot of oil risk. Europe has more gas risk. Europe gets 40% of its natural gas resources from Russia. And we talked about this a little bit last year. There's a bit of a gas crisis last year in Europe. The winter turned out to be not as bad as people feared. And so European reserves are at about 30%. And most people seem to think that'll get Europe through the winter as long as there isn't a another cold snap.
Or a war.
Or a war. No, that seems to be priced in already, actually.
Right. Okay. Because they've got a big gas pipeline, something running through Russia, don't they?
Well, not anymore. There was the Nord 2 gas pipeline to Europe, but Germany's pulled the plug on that, saying that's not happening now.
Oh, right.
So it probably means Europe's going to...
Germany's funny. Germany... I was watching the news last night, and they're talking about all these countries that have chipped in defensive weaponry. So, they can't go and fight for Ukraine directly because they're not part of NATO. They're talking about all these countries that chipped in defensive weaponry. Apparently, Germany sent some helmets. That's it. It's helmets. There you go. Watch out. Things might be falling from the sky. Better wear a helmet.
Yeah. Yeah, so Russia's not all that sort of heavy. I mean, it's interesting in the sense that it has an impact on energy and the whole energy market because it's interconnected. It's probably going to have an impact on the wheat market because the Ukraine and Russia together account for 25% of global wheat exports. Yeah, but you think about that. So if that drives energy prices higher and that drives wheat prices higher, they're both good news stories for Australia to an extent that our exporters can capitalise on those higher prices. So in that sense, it was interesting that markets got the wobbles this week because it's not clear to me directly what the impact on Australian shares is or the impact on the Australian corporate sector. Obviously, no one likes volatility and there's sort of uncertainty. And that's probably the big thing. There's no real way of knowing how this is all going to play out. But in terms of direct impact, there's not a lot of direct negatives and then some potential direct positives in terms of revenue and profits. So...
Tell you what was a direct negative was my crypto portfolio took a hit. Yeah,
not such a safe haven.
Not a great safe haven.
Yeah. Oh, no.
Digital gold, I believe it was being sold as at one point.
Yeah.
So gold was up, crypto not so much up.
No,
very much down.
No.
I think it's an interesting point. So I've been looking at a fair bit of this week, and I reckon one of the plays might be here cybersecurity. So I mean, this war has already seen. So we're Friday, at the end of the week. We've already seen 3 significant cyber attacks from. We can't say for sure that it was Russia, but against the Ukraine, which if you look at the timelines and you read between the lines, it's almost definitely Russia. So there's been 3 major cyber attacks already. There's bound to be more. They're shutting down banks and targeting government agencies. So Russia, as part of their war on Ukraine, are really trying to cripple the Ukraine's ability to mobilize, their resources against Russia. So that by shutting down their computer systems and networks, and the government's agencies, they're removing their kind of agility to respond and fight the war. And I think, to me, this is potentially a really good time to look at some cybersecurity kind of stocks and look at things like the Hack ETF and things like that in Australia, because Russia has a history here, right? Russia's got a history of not being overly in control of their cyber warfare. So they can be a bit reckless when they're firing off their cyber weapons. They're not so careful about who they're hitting. So we saw it there was an attack called NotPetya, which was in 2017, I think. So that was Russia targeting Ukraine. And the idea was that this kind of malware, this virus, would spread through computer systems and disable Ukraine's computer systems. Unfortunately, they wrote it really well and it spread, but it spread far too well, and it wreaked havoc across the entire world. So, there's this kind of track record here. There's a lot of things that are lining up to me that kind of go, you know what, getting involved in some cybersecurity companies at the moment might be a good play. And if we looked at, I had a quick look before, and that Hack ETF that I mentioned, that's up for the week. That's up.
It was 7% today,
7%,
wasn't it?
Yeah. So 7% today, but a lot of that was bounce back. But it's up 2% for the week. It's not sort of, I don't know. I mean, it's generally trends up anyway. But and of course, not financial advice. This is just me being, speculative.
I had a question about this. I was wondering this as well. But if there's more cyber attacks in the world, does that translate to more revenue for cybersecurity firms? Or do people like just buy?
Oh yeah, I would think so.
Well, I imagine it's like, well, for like the old days of antivirus when I used to have a PC, I'd buy the antivirus protection, and then the company that I buy it from would then deal with the viruses in the background and just send me updates. So like, if there's more viruses, that means there's more work for them, but I'm not paying more to protect myself from more viruses, right? Or has the world moved on from this?
Oh dear, sweet Thomas. Oh, you're so naive. So we're not really talking about viruses anymore. We're talking about malware and kind of targeted attacks. And so viruses were very much, I don't know, they're mostly signature based. So your virus software that you bought had a bunch of signatures in it that it would look to detect. Now it's much more targeted towards, detecting behaviors. So it's AI. It's kind of looking for malicious behaviors that are taking place on your computer system. But your scope is far too narrow for what most people who are going to be going to a cyber company are talking about. They're really talking about defensive weapons against cyber attacks. And these attacks are not typically just a virus that gets in. They're malware that spreads, or in worst cases, they're kind of direct, targeted attacks. And so, I think the more prevalent it becomes and the more cyber threats that are out there, then absolutely revenue generating for cyber companies. And you've seen it, the last year or 2 years, ransomware's on the rise, malware's on the rise, and the value of these cyber companies who can defend against those things has kind of gone up as well. And my feeling is that this war potentially just takes that to another level, just kind of kicks it up a gear. So, I guess we'll see. But I think this war in particular, it could be the sort of, a really very, very cyber heavy, it's not exactly a bold prediction. Well, they're going to use computers in this war, are they? But I think, it wouldn't surprise me to see a bit of a halo effect from it, where people just go, "Wow, that happened!" And because as soon as someone gets hacked, everyone looks at how it happened, what happened, and they go, "Right, what do we need to do to protect ourselves against that? What do we need to do to make sure that we don't suffer the same fate?" So, I think that potentially is a big winner out of this.
Go long cyber,
or buy tanks. So if you do think that there's going to be a massive impact from cybersecurity companies like me, then perhaps if you are playing the ASX game this week, some of the companies on the ASX, there's obviously a lot of them, a lot of international companies, but some of the ones you might want to look out for on the ASX, Tesserent Limited, ASX TNT, Whitehawk Limited, WHK, and ARC TIS Limited, AR9. So there's a few of those that you might want to keep an eye on. Certainly not a buy, hold, or sell recommendation from my portfolio. I'll be going far more speculative than that. But if you are playing along and you think cybersecurity might do well in the next few weeks, then they would certainly be ones to look out for. Right, Thomas, wages data was out this week. What did we learn from our wages data?
It came in a bit softer than most people are expecting. 0.65 in the December quarter, 2.3% over the year. This is up a lot from where it was 1.36% in the year to September 2020, so just before, like around COVID times when that was hitting. So that was the all-time low, and it's bounced up since then. But pretty soft number overall, 2.3%. So remember RBA saying they want to see wages in the 3 to 4% band before they're confident that we've got sustained inflation on the cards. So they're looking for strong threes, and 2.3% is a long way from that. So so the wages data is definitely not strong enough yet to trigger rate hikes on the RBA's logic that they've been talking about recently.
Can the RBA control, or can the government control wages growth? Like, is that something that anyone can kind of... Because that's what we're talking about, right? The 2% is how much their wages... I don't know. How do they even measure that? Like, they just... Job ads?
I don't know. That's a statistical question, I guess. Yeah. I mean, the interesting about the wage price index...
Even economists get bored by statistics.
No, I mean, this is the wage price index, the WPI. That measures like-for-like jobs. Right. So they track the same job and then track how much it's going up over time. So it's kind of interesting because we also in the week got the average weekly earnings, which is another series that the ABS publishes. But that doesn't measure like-for-like jobs. That measures just what the average person's earning. And so if people are, say, like, if you can have this theoretical situation where like-for-like jobs are flat, they're not changing, but people are graduating into higher paying roles and wages go up as a result. Because the mix of jobs is changing. There's a composition effect. So there's no composition effect in the wage price index, but there is in average weekly earnings. And average weekly earnings came out much stronger. They were up like 3.8%. And remember, we were talking about like the great reshuffle. So there was Treasury analysis that showed that in the December quarter, 300,000 people had moved on to a better job. They found that those people on average got an 8 to 10% pay rise when they changed jobs. So that might be why might be a little bit of a mismatch here that, people are finding better paying jobs, but the jobs themselves aren't changing, so it's not showing up in the wage price index.
Yeah, okay. So that's a bit of a softer number. So then everyone's happy with that number then? Like that we weren't wanting... If inflation's rising, don't we want higher wages?
People do. Economists don't.
You economists. You wet blanket. Far out. Just let us have some money, would you?
Yeah. I mean, this is sort of the thing in the Well, I think people could potentially be a bit like there's an argument to be a bit angry about the way the system's set up. So real wages are now falling because inflation's growing faster than wages. The ACTU came out and said that a person earning $68,000 a year had suffered an $832 pay cut in real terms over the past year, thanks to inflation. So not massive, but they're going backwards.
Yeah, right.
Yeah, but they're saying like there's inflation, but Phil Lowe is saying I'm waiting for wages inflation before I raise interest rates. So kind of the other way of framing that is like I'm waiting for people to start catching up to inflation, and then I'm going to jump on them with rate hikes.
Right.
So that's a bit like, not
very nice.
No, not when you frame it like that.
Yeah, gives us nothing to look forward to.
Yeah, right. Like it erodes your purchasing power, and then once you start to catch up through wage hikes, then you get interest rate hikes, which
because most people would be celebrating, would be cheering. You got a pay rise, woohoo!
Yeah,
and then but just subtly, ever so subtly, there's Phil Lowe just in the background going, rubbing his hands together, coming for you.
Nice wage gain you've got there. Be shame if someone hiked it out.
Exactly.
Yeah. But it put pay to the idea, like you remember like a few months at the start of the year, markets were thought there was 100% probability of a rate hike by June. That's now seems totally off the cards. So you're going to have to see strong wage prints in May and then follow that up in August. I think both of those are going to have to print above 3%, which would be quite phenomenal from here before the RBA hikes rates. So it's looking to me like there's no case for the RBA to hike rates, particularly with the Ukraine and all the uncertainty that's created around there. There's no pressure here for the RBA to hike. And so I think end of the year at the earliest, probably, as they were saying, in 2023 on the current data.
So I fixed my home loan a couple of years ago, and it's coming out like I fixed for 2 years, and that ends in June this year. But I was having a look around today at some rates, and they're all well up.
Oh yeah, fixed rates are popped. Yeah.
So, but even the variable rates, so they're all going up, even though the money's not going, even though the RBA rate's not going up.
Yeah, that's right.
So working on a different program. They're already after my wage rise, which hasn't come yet.
Was one of the things the RBA did. They dropped rates to the floor, and then they're like, okay, we've hit rock bottom. What else can we do? And one of the things they would do is they just fed banks money directly through the term funding facility, so long as they lent it on in mortgages, which pushed mortgage rates even lower, particularly for fixed rates. So term funding facility is wound up. So that's why fixed rates are popped. Variable rates are rising as well. Yeah, but there's a substantial amount because fixed rates went so low. A lot of people went to fixed rates, and there's a real substantial amount of those fixed rates reverting to variables over the next 12 months. So the economy is effectively already having a rate hike effect, particularly for the housing market.
Just because no one believed Phil. All right, let's take a break here. We'll grab a word from this week's sponsor and be back with more Comedian versus Economist right after this. All right, if you have been living under a rock, of course, the ASX Sharemarket Game kicks off this week. We've been talking about it. We're excited about it. And maybe you're thinking about some energy stocks. Maybe you're thinking about, I don't know, perhaps you're looking at AGL as a potential buy in the ASX Sharemarket Game. You think that's going to do well. Well, they've been in the news this week. Atlassian founder Mike Cannon-Brookes decided to make a play. He said, look, AGL, you guys are struggling. You need some help. You're not going to get your coal plant shut down. I think I can do it. And he offered to buy them for a fairly significant sum of money. So perhaps people are looking to buy them during the share market game. Thomas, what did you make of the news this week?
Yeah, so Cannon-Brookes, in a partnership with Brookfield, put in a $5 billion bid for AGL. AGL is Australia's largest power company, does generation and retail. Yeah, and it was a bit of a low bid, apparently. So, yeah, if you look at, they were offering $7.50 a share. 2 years ago, as the pandemic was breaking, AGL was trading above $20 a share. It's traded mostly above $13 a share for the past decade. So $7.50 would be a bargain. The AGL board rejected the bid, said, nah, that's way too cheap. We're knocking it back, which they did.
That's their current share price, though,
yeah.
isn't it?
Yeah.
I'm insulted. Where'd you come up with that number? It's your current share price over there.
I just Googled it. Yeah. But right. Normally you have what's called a control premium. So when you buy out a company, because you've got to buy all the shares at once, effectively, you need to, there's a premium. It could be like 30, 40, 50%. But they didn't offer that. So the AGL's energy boss, Graham Hunt, saying it was kind of ridiculous, underpriced and unrealistic was what he said, because it's just too cheap. But that said, that is currently what they're trading with, and AGL has some serious issues that they've got to deal with. Like, they've got the two arms, they've got the retail and the generation. The retail's strong, they've got 4 million customers, they're the biggest retailer in the country.
What does that mean? What does that mean, the retail side of AGL? So, like, there are other retailers only, people who just sell the energy, they don't make it, whereas AGL do both? Is that what we're saying?
That's right.
Right,
yeah.
Okay. Because I couldn't work it, because I know they're in broadband and mobile now, and I was like, surely their broadband and mobile business isn't worth like that many billions of dollars. No. But their retail
right. is. Yeah, the retail is. But the generation business is in trouble. So they've got two coal-fired powered stations, Bayswater and Loy Yang A, and they're both due to be decommissioned, but. Yeah, Bayswater between 2030 and 2033, and then Loy Yang A between 2040 and 2045. So still in the distance, but coal generation is struggling right now because renewables are just coming in so much cheaper, particularly in the day when solar's online. Coal's really struggling, and you had Origin Energy announce the early retirement of Eraring. In the same week, they're going to bring that forward 7 years earlier than expected, and kind of saying at current market prices, they're just losing money on it, and so they're going to wind it up.
Right, and that was Cannon-Brookes' approach, wasn't it? It was like, I'll wrap it all up for you. Like, I'll buy it and I'll accelerate it. And, I think he said 2035. He's like, we'll have it all done.
No, 2030. 2030. He's going for
2030.
Yeah, very ambitious. Yeah, so it's ambitious, but he's saying there's no new tech. It's all existing tech. So he's not relying on some magical tech being invented in the meantime. It's just all right. Yeah, it's all with the current tech. But there's so AGL's current plan is to split off the generation and the retail businesses and create separate businesses.
I read that.
The retail business become AGL Australia, and the generation arm becomes ACEL. But markets don't really love this idea, or a lot of big investors don't really love this idea. And part of sort of the criticism of it is you're just sort of hiving off this bad business, ACEL, to die a slow, carbon-intensive death. While the retail arm goes on and does great things.
Just go over there and choke on your own coal until you're dead.
Yeah. Yeah, right. But then ACEL without in its current form, AGL, because it has the retail business, has all the cash flow that comes with that, it has the capacity to decarbonize those assets, to shut down the coal plants and move into renewables. But if you split them off, ACEL alone doesn't have that ability, and that's what Cannon Brooks is saying. It's saying like if you demerge it, it's impossible for ACell to pivot into renewables. Its only option is to just sit with these coal assets and coal plants until they become redundant. But we'll hang on to them as long as possible. And this is.
I read something similar. There's a UK investor at Snowcap, I think it is, that said the same thing. Like that they're going to destroy like $11 billion of value in 5 years by failing. If they went ahead with the demerger, with the split.
Yeah.
So no one's in favour of. I mean, this is just one investor or investment firm.
Graham Hunt's in favour of it. He's keen, but
is he? Who's Graham Hunt?
He's the CEO.
Oh right.
Yeah, I mean it's AGL's plan, but yeah, it's got critics.
Wouldn't be any bonuses attached to a successful demerger by any chance.
Probably is. You bet he's not going to end up as the CEO of ACell. That's for sure.
As long as he doesn't end up in a party in Southeast Asia in 2015, he should be all right. Yeah, well, that Snowcap, they said that AGL was in denial about their situation. They've called out AGL big time. They're like, you guys are in denial about the underperformance of the company, which is not surprising because AGL is 185 years old.
Is that right?
I don't know if you remember trying to get Grandpa to agree to going into a nursing home, but there was no way he was agreeing to that. He couldn't even tempt him with decarbonisation. He just wasn't having it.
We're going to demerge you from the house, Grandad.
When you're dealing with this kind of vintage, you need to you might need a different approach.
The other thing I like about what Brookfield are saying, and they're doing projects like this all over the world, and their philosophy is saying it's not good enough for companies to meet environmental objectives by just hiving off their bad assets and making it someone else's problem. And that's effectively what AGL does. It's like in the demerger story, like you have a retail arm that goes, yeah, we're great, we're green, we're doing awesome things. But then you've left the market still has this, high carbon intensive asset just sitting around waiting to die. And so you're not transitioning, you're just making it someone else's problem. And so
you're just giving yourself a plausible excuse when someone comes ask you, like, it's not ours anymore. We gave it away. We sold it. It's not up to us.
Yeah.
It's like, yeah.
Yeah, but that's what they're saying. They can make this transition happen. Cannon Brooks is saying that the proposal was to buy it with $5 billion and then invest another $20 billion, so 4 times as much as they're buying it for in that transition and creating those renewable assets. So, yeah. So they've knocked it back for now, but it's definitely on the table and it's definitely front and center in the election, which might have been one of their agendas as well. But we'll see.
Right, puts it on the table. Obviously, everyone's all over it, but AGL have already forgot it happened. Certainly food for thought, though, if you are considering putting any energy stocks into your portfolio, maybe have a look at AGL, see what they're doing, see whether the demerger might make sense. That could all kick off soon. Who knows? Maybe someone will buy the company, and that's the kind of thing that could send the share price pretty quickly one way or the other. So have a think about that if you are playing along in the ASX Sharemarket Game this week. We hope that you are. Don't forget, there's still time to register right up until the 28th of April. So hopefully you'll join us. All right, Thomas, in case the news today isn't bad enough already, we've got wars, we've got inflation. The price of beer is going to go up.
The 5th horseman of the apocalypse. Rising beer prices.
This is how it ends. War, famine, and no one can get a cold one. What's that? This is just an inflation story?
Yeah, Heineken. Yeah, so Heineken had their results. Their profit jumped in 2021 from 1.15 billion euros to 2 billion euros, so almost double their profits in 2021. Good story there. But the CEO, Dolf van den Brink, is warning of there's hikes to beer prices and possible shortage. He says cost inflation is off the charts. I was going to share a chart to the Instagram, but it didn't fit.
Didn't fit? That has to be the worst excuse in technological history for not sharing something to Instagram.
I couldn't. It was off the charts.
I was going to share this on my social page. Have you seen the stuff people share, Thomas? It's not a high benchmark. It's not a high bar for quality on Instagram. I'm not sure whether you use it much, but just feel free to share it. People will shout you down, obviously, but don't be shy.
Yeah.
Right, didn't fit.
No, but see, Heineken's saying their input costs are up in the mid-teen percentage this year. So, so that's substantial, I guess. In my 24 years in the business, I've never seen anything like it, not even close. Across the board, we are faced with crazy increases. And not only is that, there might be shortages. It's like there's a whole notion of, can you actually get it at any price? You've got shortages of truck drivers, everybody's scrambling to get their products moved. Ocean freight is completely out of sync. So far, there's only been pockets of shortages, but risks are going up daily because of this global supply chain disruptions. And this was all before the Ukraine story started playing out. So
I was going to say, I mean, if beer's going up, maybe it's time to switch to something heavy, like something harder like vodka, but that's not going to work out, is it? Can't get any vodka either. Yeah.
What I found interesting about this story is saying, like, because when companies report, they normally give some forward guidance and they say, like, this is where we think the company's going. This is where we expect profits to be next year. This is where we expect revenue. And he's saying, look, it's really hard right now because there's no model that can handle this kind of inflation. It's anybody's guess what the impact is going to be on the volumes due to all these price increases. So normally there's this idea of, in economics, called elasticity. And so when the price of something goes up, people generally buy less. But how much less they buy is what you call elasticity. And so these beer companies would have very sophisticated models that would model this very closely. They would know that if they increased the price per tinny by 10 cents, they'd have a pretty clear idea of how much less people are going to buy. But he's saying right now we've got no idea. It's just such a different environment. Everything's changing. There's people, like, we've got costs are on the rise, but then people have more savings, so maybe that balances out. We just don't know, and it's a really hard time to see through the fog of this right now.
You could take some confidence though, because like when we had all the lockdowns, like, bottlers were still open. Like they were considered an essential service. So like at one point there, I'm pretty sure there was only hospitals, supermarkets, and bottlers open. Like. Yeah. I think people will be pretty forgiving for a fair while about a price increase in beer. They're not going to be happy about it, but I mean, I don't know. Maybe they back it off a bit.
Maybe they switch. Maybe they go to Strongbow. Heineken owns Strongbow, by the way. But mate,
Strongbow.
Yeah.
Do people still drink Strongbow?
I don't know.
That was the transition from soft drink to beer for most teenagers. Wasn't it?
Yeah.
Start with a few Strongbows, maybe chuck in a couple of West Coast coolers, and before you know it, you're drinking beer. Right. I didn't know that.
Yeah.
I didn't even think they were still around.
But so maybe people, if beer prices go up, maybe people switch. Maybe they go to Strongbow. Maybe they go to vodka. Maybe they go something else.
We talked last week I learned that Australia is food sovereign, right? Is there do we check for beer sovereignty or alcohol sovereignty?
Yeah, I think Canberra has a stockpile in central deserts in case of emergency.
Next to the fireworks factory. Really?
No, we don't have a reserve stockpile of beer. Well, I don't think so.
No, but we make it.
Yeah,
we make it here.
Yeah.
Like we don't need to import Heineken. We've got plenty of good beers here. Like Cooper's in South Australia is one of the best beers in the world.
Yeah, Cooper's been around forever. I mean, I guess we grow all the things that go into beer, right? There's nothing. Got sugar, we got hops, we got beer sovereign, sure.
Well, I think there should be. If there's not an economic model or whatever you call it for that, then there's an opportunity here, Thomas. You could reassure the people of Australia with one. If your other chart won't fit. Maybe you could reassure people with something around beer sovereignty. Yeah. All right, that does us for this week on Comedian versus Economist. Thank you so much for tuning in. Don't forget to join us for the share market trading game from tomorrow. If you're listening to this on Wednesday the 2nd, it all starts tomorrow. Don't forget, of course, lots of other great shows across Equity Mates Media. Get Started Investing, Equity Mates Investing Podcast, You're in Good Company, Talk Money to Me, Crypto Curious, so much to listen to, spoilt for choice. We hope you've enjoyed this show. We look forward to your company again next week. Until then, it's bye for now.
Comedian vs Economist is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Comedian V Economist are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Comedian V Economist acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander people today.